Hey there, Ryan Walmsley, American Pacific Mortgage. I wanted to put together this quick video because I keep getting asked this a lot. How are we supposed to take advantage of this new market that we're in? We went from this red hot sellers market just a few months ago to a market where inventory's up, prices are up, mortgage rates are up, and all of that is slowing sales. And really, what sellers are dealing with right now is more competition and less buyers out there. And they used to get multiple offers, and the bidding wars were very likely to happen. Sellers could get $20,000, $30,000 over their list price, and that was normal. But now that's not the case. Sellers are actually having to either reduce their list price to be more realistic with where demand is, or offer concessions to entice buyers to purchase their home because there's more competition out there and more choices for buyers. But with buyers, this puts them in a new position that they haven't been in a while as well, having negotiating power and those choices between different properties. But really, what buyers are struggling with still is being priced out of the market by interest rates, and really that's a byproduct of inflation and how inflation has affected mortgage rates, because mortgage rates are highly dependent upon what inflation is doing. And that's because investors who are lending money for a 30-year period want to make sure that inflation doesn't erode the earning power of the money that they lend. So they combat that by raising interest rates. Inflation will eventually get under control, but right now in this market, it's not yet. And how do we take advantage of this market? And a solution to that is a temporary interest buydown program called a 2-1 buydown. And I put together this comparison between a traditional 30-year mortgage where there's no interest rate buydown and a 2-1 buydown to show the advantages to a buyer and a seller, and how everybody can make out in this new environment that we're in. So let me pull this up here. And for this scenario, this is based off of a $500,000 purchase price with 10% down. Now, everybody's situation is going to be different, whether it's purchase price, down payment amount, credit scores. But I have this based off of this situation. If you'd like to have your scenario ran specifically, feel free to give me a call. My number is 602-799-8625. There will also be a link to apply online after this video ends, and we can run through your specifics and get you all the numbers that you need if this program makes sense to you. So for this scenario, again, we're looking at a 30-year fixed conventional loan with no interest rate buydown versus a 30-year fixed temporary interest rate buydown. And basically how this program works is it relies on a subsidy from the seller in the form of seller concessions. Now, we know that we're seeing seller concessions more and more because of that increased competition between sellers trying to get buyers to purchase their homes. So basically the program relies on getting that concession, and then that concession is applied towards the first 2 years of the mortgage to lower the interest rates. So for example, if interest rates today are 6%, in the first year on a temporary buydown, it would be 4%. And in the second year of that mortgage, it would be 5%. So the subsidy gets applied towards lowering the interest rate, and that is good for the first 2 years. And then the remainder of the mortgage is at the permanent rate of whatever it would be. And in this case, it would be a 6% rate. So now if you were to find yourself in a situation where you were refinancing, having the opportunity to refinance, whether it's because interest rates improved or markets appreciated a little bit faster in the area where you purchased, and you could eliminate the mortgage insurance, you can still get that money and have it benefit you. It doesn't go back to the seller. It doesn't stay with the bank. It goes towards lowering the principal balance on that mortgage that you're getting ready to refinance. So the money stays with you. Now, let's take a look at how these compare in this situation. So for the first year, the monthly savings between a regular 30-year fixed and the temporary buy down is $550 less per month than in the first year. And then in the second year, the savings goes to $289 less per year to do the temporary buy down. Now, in the third year, it does go back to where the permanent rate is, or pretty close. But let's say you find yourself in a situation where you're trying to decide whether or not you're going to continue to rent instead of buying a home, or you're a seller and you're considering just waiting things out, seeing how it goes, or if you're forced to be in a situation where you have to sell and then you're deciding whether or not you're going to buy again or rent. Let's see what the monthly payments in that type of situation would be, comparing buying versus renting, as well as determining whether or not the amount of equity that you could gain is a determining factor for you as well. So in this situation, we're going to assume that you're not selling the home in the next couple of years, and you're going to buy this home. The monthly payment again would be about $26.76, but this is also including maintenance and repairs that could potentially come up, or if there is an HOA on the property, we're buffering here for that type of additional costs. So in the first year of renting, this is comparing a $500,000 purchase price with 10% down versus rent on a $500,000 house. So an equivalent property, you could expect to be spending around $3,100 in rent versus paying $2,700 to purchase in the first year. Now, this chart here shows the comparison between the mortgage payment and a rental payment in the first year. And in the second year, you can see that the mortgage payment is only slightly higher than what rent would be. And that's with the increase in the 2-1 buy down, but also the increase that we would expect for the rental market. Rents increase on an average of 6% per year. And as we move forward in time here down this annual path, the monthly payment on the mortgage becomes fixed and stays at that 6% rate. Again, this is assuming that you're not refinancing if rates go down, and you're not refinancing to eliminate mortgage insurance. So this is worst case scenario. But rents will continue to increase at an annual rate of about 6%, and it just becomes more and more unaffordable to be a renter than it does to be a homeowner. So the difference in cash flow is clearly in the advantage of being a homeowner. But also there's another part of the equation that we need to consider, and that's appreciation gain from your home appreciating. And this is using a conservative rate for appreciation in the first year of 3%, and it does go up slightly from there, assuming that we're going to continue to deal with the inventory challenges that are in the market right now. So lower inventory means appreciation gain. So this is over a 9-year period, but year one, we're only saying 3% appreciation. And then the amortization gain is the amount of principal that you pay down when you're making your mortgage payment each month. So now if we're looking at waiting 2 years, let's say, instead of purchasing, waiting out and see how this market goes, just in the first 2 years, you're looking at walking away from about $62,000. So within those 2 years, you might refinance the mortgage, and that could be an additional cost of around $3,500 to do a refinance to lower your monthly payment and accelerate your amortization. But it's clear that being a homeowner is the right move, and to be able to take advantage of the market that we're dealing with right now, a 2-1 buy down is a fantastic way to break yourself into being a homeowner, or to help you move up to a new property if you're considering selling. If you do have any questions about this program, I'd love to break down your situation in detail to see if it makes sense for you. Feel free to give me a call. My number again, 602-799-8625. Ryan Walmsley here. I'm here to serve. Take care.